The most frequent inquiry a financial analyst encounters isn't whether the system will fail, but exactly when the structural degradation will be officially acknowledged. This chart shows the fiat dollar's purchasing power since the passage of the Federal Reserve Act in 1913. It illustrates a steady decline, losing over 97% of its value. Today, retaining less than 3 cents, this proximity to zero represents a terminal threshold. At this specific limit, the mathematical constraints on the monetary system leave the state with 2 primary paths forward. The first path is sovereign default. This involves an outright refusal to honor credit obligations, which typically triggers immediate domestic collapse and geopolitical retaliation. The second path is a monetary reset. While often described using terms like revaluation, this process functions as a state-level Chapter 11 bankruptcy restructuring. To understand the outcome of this restructuring, we can look at how a reset modifies identical portfolios of fiat currency and physical assets. Identifying the mechanics of a sovereign restructuring shifts the perception of a currency reset from an unpredictable catastrophe into an observable sequence of events. Historical data indicates that currency resets follow established trajectories rather than occurring in isolation. These systemic indicators are visible in the historical records of nations like Mexico, seen in Venezuela, records from North Korea, and finally, Zimbabwe. This dashboard identifies initial structural failures, mathematically unsustainable sovereign debt, and persistent negative export balances. Governments impose tariffs as emergency liquidity injections, addressing acute cash flow shortages. To manage perception, central banks mask true inflation by excluding food and energy from standard CPI metrics. When these indicators align, the state typically sustains basic operations through aggressive monetary expansion. Historically, this expansion reaches a critical point, where roughly 30% of the total domestic money supply is generated within a 5-year window prior to a reset. This rapid dilution of the monetary base serves as the final catalyst, pushing the system past the threshold of sustainability. Reset Day is characterized by a synchronized government announcement of an immediate transition to a new currency architecture. The primary tool of this transition is an optical redenomination of account balances. A conservative 10-to-1 reduction is a standard baseline in these scenarios. Official communications describe this reduction as a nominal accounting optimization intended to simplify daily transactions. Before a reset, inflation pushes coffee to 1,000 pesos. Following redenomination, the state resets the price to 1 peso. But inflation continues, quickly driving it to 4 pesos. This seemingly minor 3 peso increase mathematically equals a massive 3,000 peso surge in the pre-reset currency. Redenomination creates an optical illusion. It does not resolve the structural deficit or the continuing decline of purchasing power. This optical illusion conceals the divergence between fiat capital and physical assets. This ledger compares 2 allocations of $1 million before a reset, one in fiat currency and one in physical gold. After the state-mandated 10-to-1 devaluation, the fiat position drops to a nominal value of $100,000. Gold, however, has historically undergone a conservative 6-to-1 revaluation against the new currency architecture, resulting in $6 million of liquidity. This results in capital destruction for the fiat holder, who must now cover operational expenses with a fraction of their original wealth. For the physical asset holder, the restructuring produces a massive advantage in purchasing power. During a reset, broad asset classes like real estate and equities typically contract as liquidity vanishes from the broader market. Historical data from the Great Depression confirms that these points of economic contraction cause widespread distress, forcing individuals to liquidate assets. Institutional wealth utilizes these transition points to deploy their expanded liquidity, acquiring distressed broad assets for pennies on the dollar. Holding tangible assets bypasses the redenomination illusion, turning a systemic currency collapse into a generational wealth generation opportunity.